Welcome, everyone. Thanks for coming along this morning. I know it's a tough gig. I know HMC Capital is doing a briefing at the same time this morning, so I'm very appreciative that you've come here rather than there. And I suspect the cohort of investors in this room is a different cohort to what might be in that room, right? So whilst they're one of our clients, we're quite different companies. Anyway, I want to jump into it. The release on the ASX is there if you're looking for it, because I know some of you will be looking for that. So you can see that it's just come out. So today I'm just going to give you an introduction on things. I'm going to hand over to Joe Platt, who's going to take you through a Q3 update. So we're updating the funds under management levels for February. So that is important to look at. Ian Wesley's going to talk to you about Trustee Wealth Services. I've got Andrew Godfrey who's going to talk to you about corporate and superannuation trustee services. Last year, we didn't cover asset management, and a number of people asked for us to do that. It's a very important part of the business, a very profitable part of the business. And so Darren Thompson, who heads up our asset management business, is going to talk today about that. I'm going to cover people and I'm going to cover risk management. And then Ping Lee, who you saw, if you were here last year, is going to cover our technology plans, and then I'll finish up with an outlook. So we're going to have two sort of stops for questions as we walk through. So I think once we get past asset management, we'll stop there and get some questions, and then we'll get more questions at the end. So let's jump into it. So firstly, Equity Trustees. We regarded ourselves as Australia's leading trustee company. I think our independent model is increasingly in favour across most of the market. We've got very powerful tailwinds in the industry, both for our private client business in terms of intergenerational wealth transition, and also for our two corporate lines of business, super and corporate trustee services, are really driven by the growth in the superannuation assets of the market. It's clear we've got market leadership across multiple segments and geographies. What I'll show you as we go through this presentation is just the nature of the long-term nature of the enduring revenue that is in this business. I don't have updates on employee engagement and client satisfaction. We're surveying at the moment, but the last results are really high in both those areas. Technology is increasingly important to this business. People obviously are, but we've spent a lot of time on technology over the course of the last 3 years. And we see growth opportunities across multiple parts of the business, both organic and inorganic. So just a couple of key investment highlights and a way to think about the company. I guess, firstly, position of strength. It's difficult to replicate some of the assets that we have. So the brand and the reputation of the company, a leading governance position in most of the appointments that we have. So really it can't be displaced from those positions. As I said before, market leadership, market share leadership across many markets that we're competing in, an unrivaled set of licenses. So no other financial services company has the full set of trustee licenses that we have in the RE space, traditional trustee space, and the superannuation space. Our superannuation license is a particular extended public offer license that other players don't have. And we've got specialist people in all these forms of trusteeship enabling us to do that. That's not easy for anyone to replicate. Of course, there are competitors that have got a lot of those things, not many competitors. So it's a great position. The track record, I think, over the last, if we go back through the last 8 to 9 years, which is the sort of the time tenure of this, the bulk of the team, I think, strong share price performance versus peers, very healthy cash flow generation, although we've churned a bit of cash in the last 2 years as we took on AET and integrated that and built the NAB1 platform. Consistent growth in dividends, high margins in most of these businesses that we have. Excellent portfolio of clients. We've got some of the incredible clients on our books. It's a diversified client base across the 3 lines of business that we've got. Low concentration risk, that's getting lower, and low client turnover. And then, as I said before, growth opportunities in our traditional markets, including new markets, digital markets. I think we have an opportunity, as we've done in the past, to create new markets. Effectively, we created the superannuation, the independent trustee superannuation market, and we see other opportunities to create markets that others can't. And there are inorganic opportunities in our core markets, and that's where we focus on the inorganic side. That's just a snapshot of the company. We're overseeing $220 billion of assets. Market cap is now just under 900 million. We've just entered the ASX 300 in the last re-rating of the index. 147 years young. The company was established in 1888. Three of the companies we've acquired over time was established 10 years earlier than that. So it's a very long dated business. More than 800,000 beneficiaries being protected, 260 corporate clients across the business. So a big client list, and we're on 462 staff at the moment. I just want to be clear, the business is primarily trusteeship, and we've focused singly on that over time. But there are other services that we offer, and I just want to put them in perspective. Asset management for us is a core part of trusteeship. So not just protecting assets, but managing and growing them. So, and Darren will talk to you about that. Advice, we provide advice where we need to provide advice. So we don't market that service really to the broader market, but as important, some of our beneficiaries, we would not be prepared to pass off to other advisory firms, and we provide that advice ourselves. On the custody front, we provide custody for real assets only. All other custody, the 220 billion, we outsource to the major custodians of the global custodians and some locals as well. And on the administration registry side, we don't provide those services to the market. We do that in-house for our trustee wealth services business, and we outsource it for all of our other superannuation and our corporate trustee services business. So that's the framework of the business. I mentioned before dividends. You can see there the record of growing dividends each year. The only year where we flatlined was in COVID, because almost every financial services company went backwards in that year, but we maintained it. And you can see the first half 25, which we just announced at 55 cents. So really consistent record on converting cash into dividends. Our purpose is really simple, and it's to help people take care of the future. And our vision is to be Australia's leading trustee company. That doesn't mean being the biggest. We've got a big competitor sitting next to us, but being the leading trustee. So, and we do see that we're really moving to that position. We've guided the business really with 4 key targets, and I've talked a lot about these before. So focus on clients first and foremost. Ensuring we've got employee engagement, because this is very much a people business, growing shareholder value and deepening our impact on the community. And we report on those each year. We can't report on all of them at the half year, but we certainly report on all of them each year. On the asset side, the assets effectively, the way we look at it, is the brand, and we do everything to fiercely protect the reputation of the company. The balance sheet is a conservative balance sheet. People are absolutely critical to this, to having the right people across the organisation. And as I mentioned before, the licenses are a really important part of the assets that we have. And, we seek to have, a really great compliance track record with the regulators, despite the complexity of the business, because those licenses are critical to us. Board of Directors, only change that I'll point out there is Kevin Early retired at the last AGM. He'd been with us for 12 years and chaired our audit committee. And the board chose at that point in time that we would not replace Kevin. We'd put on Rob Dalton a year earlier, and he now chairs the board audit committee. And we think this size board is right for the scale of the business, the way it stands. The leadership team, there's been some changes on the leadership team since we last spoke. Welcome, Jo, who many of you already met, because she joined and had to deliver the results within about 3 weeks. Jo, was it? I think, yeah, and did an incredible job in doing that and getting across the business. We also have a new chief risk officer starting in a month's time. We've had some changes in that role over the course of the year. But I think I would point out about this leadership team is there's a great balance of the longer serving ones, and Ian won't mind me saying 18 years it is. So, incredibly deep experience in trusteeship. And Ping's been here heading up technology for the last 12 years. I've been here 9 years. So a lot of experience there. Alicia in marketing for 10 years. And then a lot of new faces, Georgie and Samantha joining us about 3 years ago. And Jo, as I said, joining us last year. So a well-balanced team. I mentioned before market share leadership, and just to be clear where we do have leadership, it's not easy to get public definitive data in all forms of trusteeship. So just to make that point to start with. But we know, based on what we see publicly, is that we're the equal leader in philanthropy in Australia. We're the clear leader in the health and personal injury sector. That's important. That's the fastest growing sector in trustee wealth services. Estate management, we're the equal leader in that market. Estate planning, we're really the only trustee company dedicating significant resource to estate planning. So we lead that market. Continuing trust, the equal leader, and advice, it's a specialist area for us. On asset management, well, we've got a fit-for-purpose, customised estate asset management capability that Darren will talk you through, designed exactly for our trusts. On the corporate side, the clear leader in responsible entity services have been for 20 years, and that position has been strengthening in the last couple of years. We're a small player in custody and real assets, an area we want to build significantly, a very small player in debt capital markets and securitisation, and another area we want to build over a long period of time. And on the superannuation side, we're the only provider really of scale in providing independent super trustee services. We are also the only provider of trustee services for small APRA funds. So we had a portfolio of those which we acquired from AET. We've also recently taken on the appointment of Perpetual's small APRA funds. So we're the only trustee in that space. So a really strong position. And the AET acquisition, as we've mentioned, really helped us geographically, particularly in Adelaide and Perth, to get leadership in those two markets. And we already had it in Melbourne, and we've got a good position in both Sydney and Brisbane. The business is increasingly diversifying. So you can see there in the centre, the three main blocks of business: trustee wealth services, the biggest share of revenue, and super sitting there at 18% and corporate at 21%. If you then break it out, right, across to trustee wealth services, you can see a very wide range of products and services. And if you break out the corporate side, it's predominantly the responsible entity services that we provide dominates that business, but there's no sub-segment of this business that has more than 19% of the revenue. So we've increasingly diversified the business. Joe, do you mind just passing me my glasses? I could read these last year, but thank you. Thanks very much. This is a new slide, and it just shows the client concentration risk that is in the business. And if you look at material clients, so those that are defined as having more than 0.5% of our revenue, so you can see that that has reduced over the last 4 to 5 years from 34% of revenue in that group of clients to 24%. So that's a reflection of the AT business coming on, but it's also a reflection of some of the clients that had high client concentration risk had lost some of their investment mandates in CTS. They've lost their own clients. So what it's meant now is we have much less risk than we had before. And you can see the number of clients there on the right-hand side. We've currently got 7 clients that have got more than 1% of group revenue. Most of them are superannuation, so they're not clients that are really at risk of leaving. CTS clients, they are potentially at risk of losing their clients. Now, these are very successful fund managers that sit in this category, so that's not really a risk that we see at this point in time. So it's good to see that concentration reduce, because people who have followed this stock for a long period of time would have known from time to time we've had large losses of CTS clients. Some, they've moved away. If I go back to the PIMCO time 8-9 years ago, others have just lost their client base in big hits because they're institutionally based managers. So hopefully that's clear about how that's progressing. This slide's important. It talks about client turnover, and I guess the key thing about this business is that client turnover is low. In many of these cases, the only way we can lose the business is to effectively voluntarily retire, which we don't do very often, just to be clear, or to have a court order to ask us to force us to retire, which very rarely happens. In fact, I don't think it's happened in my time. And of course, you know, if a CTS client would like to leave and we agree, well, we'll go through that process, it still requires a unit holder vote, which is not that easy to get in any event. So there's not a lot of churn in any of this business. Some of the business is subject to inflows and outflows, and particularly superannuation and fund services, as you can see. And you know, that can create some volatility in that. But most of the trustee wealth services business, once set, it's not subject to inflow and outflow to any great extent, other than health and personal injury, which is a drawdown over time. So hopefully that's clear. So very low turnover of clients. We showed this slide at the half, right? And just showed that we're coming to the end of a 3-year major transformation program, integrating AET and deploying a whole range of new technology. I'm not going to run down through all of these initiatives, but they are coming to an end. And now when we go into the next year, FY26, we'll be moving into a normal BAU type setting of technology investment, which we had prior to this 3-year period. But you can see the stack of work in the last 18 months that is nearing its end. I'm going to hand over to Jo, and she's going to give you an update to February.
Thank you, Mick, and good morning, everyone, and thank you so much for joining us at this busy time of year. I'll give you an update on 2 metrics, one on FUMAS growth to the end of February. We're still a little bit live on the end of March, so we weren't able to hit today's date with that update, and also some more information on the correlation between markets, AUM valuation and revenue, so areas that we know we've talked to you about in the past. FUMAS at the end of February was 229 billion, an increase of 3.2%. This has been CSTS driven over that period. I do want to call out at December 31, those that are eagle-eyed will note that we've restated the December position to 222. That is a reduction of $2 billion. There was an overstatement in the happy client FUMAS that was reported at the time, and I'll talk a little bit about that shortly. If we look at the growth by business line, CSTS really has driven the growth in FUMAS over these 2 months. In the corporate side, it's increased by $5.4 billion. And this is really largely driven by inflows to existing products. So about $2.5 billion worth of inflow into existing products. And these are from clients such as GQG, Future Group, Partner Group, Orbis, and global equity type products. And you can see the quality of those managers is really driving our FUMAS growth. Market contributed about 1.5 billion revaluation to the asset base, and that's based onto the average mix of assets for this group. And there was net 1.4 billion of new business over the 2-month period. So really strong growth coming through in CSTS. To also call out, you'll see we've stacked this now to show of the AUM we hold in CTS, what percentage of those assets are being billed on an asset-based fee versus a fixed. So for CTS, it's 65% of current asset base is broadly being billed on an AUM basis. Turning to superannuation, an increase of $1.6 billion, driven largely by HUB24. For those who may have noted in the AFR on Monday, there was an analysis of member switching flows, and it showed HUB24 was the leader in the market at $6 billion for FY24. So again, having a really strong partner that we work with is really underpinning the flows into super. To call out, we have the $6 billion inflow from Perpetual to come that occurred in March. And for superannuation, we see around 36% of our assets are attracting an asset-based fee. For TWS, AUM was broadly flat, again, just calling out the $2 billion restatement of the December result to $18.0 billion. And this includes the asset management segment that you can see broken out on the right. Just to note that we spoke to a number of you at the half year around the apparent dilution in revenue bips for TWS on the back of that AUM data. Now that we've corrected it, I can report that the result was 56.9 bips versus a prior year of 58.9. And there were some prior year issues there. So the message is broadly flat revenue yield in TWS. Turning now to correlation of markets to AUM and revenue. We shared in the half-year result the mix of asset allocations by our key lines of business. So I don't know, I'd call the mid-blue for TWS, for instance, at 41%, that's exposure to Australian equities. The pale blue is global and 40% generally fixed income. The second column shows the percentage of fee composition or broadly revenue that is exposed to AUM. So again, for TWS, for example, 78% of asset/revenue is driven by AUM-based revenue, and for CTS around 37%. We note in the third column the characteristics around distribution of income. So for TWS, high levels of income distribution, given the nature of the trusts, whereas 80 to 90% obviously reinvestment occurring in corporate and STS. So if you roll all that together, what does that mean? The last two columns give us the overall view that for a 10% movement in investment markets, we see TWS assets broadly move by 5%, CSTS by 9%, and similarly for STS. If we then switch that into what does that mean for revenue, for TWS, it means around a 6% correlation for a 10% movement in market, 6% for CSTS, and around 2% in super, given the high exposure to fixed fees in that segment. So on that note, I'll hand over to Ian to give us an overview of TWS.
Thanks, Joe, and good morning, everyone. The first thing I'd like to do is just sort of re-establish, those who were here last year will have seen this leadership team that helped me run the TWS business. And really pleasingly, all we've added to here is another year of experience to the team. They've all got really deep experience in each of the business lines that they look after, and they all work incredibly well as a group together. And I think a really important aspect of this leadership team that I have as well is Ravi Malhotra, who is there on the right-hand side of that diagram, is although he's listed there as 11 years experience, he actually came across from the AET acquisition. So he's been part of my leadership team since December of 2022. But he has played a critical role in the cultural integration of the AET business, which really has underpinned the success that integration has showed, as reported at the half by Mick and Joe. So the TWS services that we have, we think of them in two groups. On the left-hand side, there are our traditional trustee services. And while they're listed separately, they are very much related. And I'll talk a little bit about that in a moment. And then on the right-hand side are sort of the new markets that we've entered into. Some of those leverage that traditional trustee capability, whereas others are standalone. And I'll go through those in a little bit more detail. Mick mentioned earlier that we do have market tailwinds helping us, and that is particularly true for TWS. If I think about, if you think about that, the over 80s is the fastest growing cohort of Australians right now. We have a lot of services that fit that market. There's the well publicised intergenerational transfer of wealth that is about to commence. There's incredible complexity now existing in Australian households, which makes succession and estate planning a critical component of how people plan for their future. The government objective and the recent Productivity Commission stated objective to double giving by 2030, obviously being a big philanthropic player, that is a critical part to our growth going forward. There's increasing empowerment of First Nations people and the rights they have to their traditional lands. And, we firmly support that and work with communities to manage the royalties that they're able to get from those native title rights. And then NDIS legislation better supporting Australians who live with disability. Obviously, in our health and personal injury space, that really helps us manage the ongoing cash flows of these clients and enables less capital to be distributed out each year and therefore to be reinvested and protect the long-term future of these clients. I'll now go through each of the business units in a little bit more detail. And as I said up front, the traditional trustee services that you can see there are very much related. If you look at the left-hand side there, we look at estate planning as essentially distribution. Estate planning is obviously where we help Australians plan how they're going to transition their assets to the next generation or to whatever beneficiary they choose to pass their monies on to. And really, that is a core part of the business that the business was founded for back in 1888, or as Mick said, in some instances, 1878. Excuse me. So that is really a distribution point for us, and that's where our estate planners meet with clients, and they invest a lot of time. There's a lot of expertise. It's a very big team, as you can see. There's 21 people who sit in that team. We have representation in every office in Australia. And a critical component of where we want to be providing advice here is where people need independence for those downstream services that you can see there, estate management, and then the two trust boxes on the right-hand side, which I'll come to in a moment. This is a really big barrier for entry for us, for competitors to enter this space. And as Mick said earlier, we are the only trustee company now that is offering all the services that are shown on this slide. We meet with the family, we go through their estate plan. Our records show that typically then there is about a 15-year wait between when that estate planning happens to when the person passes away. And that really is when our revenue starts to flow, at that point when the person passes away. The first box there, the estate management, once again, we've got 21 people there who work in that team. They've got deep expertise in working with families who've just lost a loved one, which is a real skill that is, we've got to work through a lot of financial matters, gather in a lot of assets, but you've also got to deal with individuals who are grieving and are really uncertain about what this loss in their life means to them going forward. It is also a time where it can be the first time that beneficiaries hear of our involvement in the estate planning of their parent or their aunt or whoever it is that they are a beneficiary of. And that can create a lot of challenges in developing a relationship. If you think about that, you might have lost a loved one in your life who you are a beneficiary of their will. You probably expect that you're going to know who's going to be the executor of that will. In most cases, our beneficiaries, when we work in this instance, don't know of the role that we have, and it can make the relationship very challenging to get started with. But through the professionalism and the diligence of the team, that they build a rapport over the estate management process, which is a transaction essentially. It's a long transaction. It takes typically about 12 months. It can extend out over 2 years. It does have fund-based fees, but they are one-off fund-based fees. They're not annually occurring. They are strictly a one-off fee, but they are typically higher than the other fees from a percentage perspective that we charge on those annual fees. At the end of that estate management process, one of two things happen. We either pay the estate assets out to the beneficiaries directly, and this is a really important role that our advisors play here, because we've had, say, that 12-month journey through the estate management process to build rapport with the beneficiaries. And then the advisors can work with the beneficiaries to understand the best way for them to transition the assets they are going to be receiving to the estate for their own benefit, whether that's a contribution to super or what, paying off a mortgage, whatever it may be. So it does really represent a really strong advice opportunity for our advisors to work with those beneficiaries. If the assets are not being paid directly out to a beneficiary, what will happen is the money will pass into one of the two boxes on the right-hand side there, with the bottom box being what we call continuing trusts or testamentary trusts for living people. So that would be where someone sets up a trust for an individual who, for whatever reason they've determined, needs some help to manage the assets that they are putting aside for that person. And this is a really important concept here, because in virtually all of the clients that sit in this cohort, we have two sets of beneficiaries. So the assets get passed into the trust, and let's just say it's $1 million, for instance, goes into a trust. That $1 million is invested and it generates income, and that income is paid out to the person who is the beneficiary of that trust, what we call the income beneficiary, but the capital remains in the trust, and that will grow over time. And then when that trust vests, which typically for us is between 20 and 30 years, there'll be another set of beneficiaries who we call our capital beneficiaries, who that original $1 million, whatever it's worth when the trust vests, will then pass to. So that's a really important concept, that we have to keep capital and income separate. And that really is the genesis of our in-house asset management capability, is ensuring that we have investments that we are really clear on capital and income. And Darren will talk a little bit more about that when he talks to you a little bit later on. The other type of trust there is if someone has philanthropic intent in their estate planning documentation, and they create a philanthropic trust or a perpetual charitable trust under the terms of their will when they pass away. So that can happen immediately, i.e. go straight from the estate management into the perpetual charitable trust, or it can go via a continuing trust. There might be some living people that someone wants to provide for whilst those people are still alive, but when they pass, that trust actually vests into a perpetual charitable trust. Once again, there is definition in virtually all of the cases between capital and income. The capital is retained within the perpetual charitable trust, and the income is paid out to nominated charities or causes that testator would had in mind when they created the trust. So that separation of capital income is once again critical in that space. And as I said on the bottom there, the duration there is 20 to 30 years. For a perpetual charitable trust, it is perpetual, so it is forever. So it's an incredible appointment and a great honour that we have that people select, that they are prepared for equity trustees to manage their assets on their behalf for forever, which is I've worked here 18 years. Every time I say it, it's a really strange concept, but it's a real privilege that we have. As I said on the slide earlier, where we had all the services listed, there is a little bit of connection between those traditional trustees services and some of those more contemporary ones, and philanthropy is a good example of that. If you look at the left-hand side there, that testamentary or the perpetual charitable trust is what I've just spoken about. So you can see there that we've got over 750 accounts, over $3 billion in funds sitting there. And if you flow down to the bottom there in that social impact team, the vast majority of that $178 million that we distributed last year actually came from that testamentary capability, that $3 billion that we manage. Gives us incredible privilege, as I said, to be able to work with community and make real change and really impact the lives of everyday Australians. But it also enables us to build great reputations and really work in partnership with a lot of the not-for-profit sector and Indigenous communities. And that's something we've been able to leverage to create what we call our active philanthropy services, which is really a more modern way of giving. The traditional way has people have given when they've passed away, hence that testamentary book that has built up over the history of the business. In more recent years, sort of the last 20 or so, people have started giving while they're alive. And when you think about it, that's a much more fun way to do it. You get to enjoy the benefit of your giving and see how you can help people live better lives. If you are going to participate in active philanthropy, there are really two ways that you can do that. They're both ancillary funds. The first of which I'll talk about is a private ancillary fund. And the best way to think about that is it's very, very similar to a self-managed super fund. If you want to control everything and be responsible for everything, all the compliance, all the regulatory reporting that's required, financial statements, and absolutely manage the investments, then you need a private ancillary fund. If, however, you really want to give money into a structure that enables you to practice philanthropy, then a public ancillary fund is probably the vehicle for you. In that case, it is like a retail superannuation fund. All you've got to do is choose who you want to give the money to. We take care of all the rest. And that money is managed in-house, once again, by our asset management team. The public ancillary fund that we have internally, you can see there's got about 400 clients on it and about $400 million. Recently, we've invested in technology that we've imported from the US, a platform called iFi, which is market-leading technology in the US and has been adapted for the Australian business. Our clients are now sitting on that, as are a couple of external wealth management firms that you would know quite well, JB Weir and Evans and Partners, are now utilising that technology as well with us as their trustee for their foundations that they can then promote to their clients. But really excitingly as well, we're about to launch a campaign where we're going to have a marketing campaign for the first time, trying to attract clients via a digital marketing campaign. So it'll be the first time that we'll be able to take philanthropy to a broader market. The entry point, traditionally people think of philanthropy as being really for the wealthy, but because of this technology and the ability now that a client will be able to pick up their phone, they'll see some content on their socials, oh, I want to get involved in that, or they might have a cause that they want to start. They can open up an account, deposit money and give to whatever charity they want to give to or cause that they want to give to without speaking to anyone at Equity Trustees. Because of the technology, we've been able to lower that entry point to $5,000. We're incredibly excited about what that potential is going to be, and that campaign will go live in about 4 or 5 weeks' time. So it's in the middle of May. Moving on to the native title part of our business now, you can see there that the yellow dots on the map there are all the communities that we work with. You'll see there that we've got 26 clients. For those that saw this map last year, there was 23 clients on there last year. So we have grown that book by 3 clients this year, which is a really strong amount of growth in this space. Not a lot of opportunities come up and not many communities change trustee. In addition to that, we have also been able to retain one of the biggest clients. We've been reappointed on that client a couple of months ago. So, we're in really strong position with these clients. They are challenging clients to work with. Once again, you need incredible skill set and very unique skill sets. If you've ever been out to community and worked with Aboriginal communities, it's not like most of us experience when we go to work every day. So people need special skill sets. They've got to be able to manage or work with Darren and other asset managers managing millions of dollars worth of assets and understand what all of that means. But then they've got to work with families who are living in absolute hardship and really struggling to make ends meet. So it's once again, an incredible, difficult role to recruit for, but really pleased to say that we've got 17 people who work in this team. Most of them are in the Western Australian office, because whilst we have clients all over Australia, the vast majority and the most complex matters sit there in WA. But we've got really strong relationships with Aboriginal communities that we work with, and we are very passionate about this space. Every time you go to work there, you do see the difference that we can make. The tenure of these clients does vary. Some of them roll. You have to get reappointed either every 3 or 5 years, but typically the mechanism to remove a trustee is quite difficult. And I'll give you an example of one of the communities. For if you're the incumbent trustee, for you to be removed, the community has to vote in favour of another trustee and achieve 75% votes in favour of that trustee. So a very, very high bar to achieve. And in my time, I've never known that happen. And some of the appointments are also perpetual in the same way that I spoke of earlier about perpetual charitable trusts. I'll now talk about health and personal injury. As Mick said earlier, this is the fastest growing part of our business. And this, along with the native title book, was a really big change that came about Equity Trustees when we acquired the AET business. We had market leading positions in those traditional trustee services. When I say we, Equity Trustees pre-AET acquisition, as well as investment mandates and asset management capability, but they had market leading positions in health and personal injury and native title. So by bringing the two businesses together, it gave us scale and market leading positions across all of our chosen markets. And we actually are a clear #1 player in this space now. So the yellow dots represent where we have people on the ground. And that's really important, because a health and personal injury client can be categorised by someone who unfortunately has been victim of a catastrophic brain injury, typically through medical negligence or a car accident, where they no longer have capacity to manage their own affairs. And then they are awarded compensation in lieu of those injuries. And these awards can be up to $30+ million. And you can see from the numbers down the bottom there that the average is sort of $3.5 to $4 million across the client base. So they're all significant clients whose needs don't really change once they get established, because the award really it works out, okay, this person's going to live for however long. And in most instances, they have virtually normal life expectancies. So we have these clients for many, many decades. And the award is there to really support them in their everyday needs. Importantly as well is a lot of these assets are able to be held in superannuation. I didn't touch on it earlier, but the perpetual charitable trusts are a tax-free entity. So a lot of the ways that Darren and the team manage the money is with that in mind. And what we're able to transfer is that expertise into the health and personal injury space, because obviously once these clients are in superannuation, they have special allowances to be actually in pension mode, regardless of their age. They're in a tax-free environment. Some of these clients are as young as 10 years old, and they might have $20 million in a tax-free environment for the rest of their lives. So having that asset management capability of dealing with tax-free assets has been really useful to help manage some of these portfolios. It's once again, this is an incredibly difficult role to recruit for. And it's because, unfortunately, you know, it's a big event for every family when they become a client of this part of the business, and they're all tragedies in their own right. And it is a long process for families to get compensation. And through that journey, we've got 5 to 10 years there on the diagram, but it quite often can be a little bit longer than that. The families really struggle. They've obviously got to deal with the incident that's happened, and their lives have changed forever. But quite often as well, the families, the parents have both got to give up work to become primary carers. So, you know, financially, they become really, really difficult for the family to cope. And more often than not, the family's not in great shape from a functional perspective by the time the award is generated. They then get a large amount of money, and they kind of, not everyone, but there can be a bit of a, oh, thankfully the money's here, we now need to do all these things. But that's not what the money's for. The money is for taking care of the injured person for the rest of their life. So our relationship managers have to be able to manage that transition from the period where the family's effectively got nothing at all to when this wealth arrives, and then navigate the family through that journey to understand that it's about the long-term future of the injured person rather than the right here, right now. And that can once again be a challenging way to get a relationship up and running. We've got a great team, as I said, a lot of people, as you saw on the last slide, that is unreplicated. And they've got these types of skills where they can manage that. Once again, they deal with large amounts of money, and but also have to deal with empathy with the family. So as we've come through the AET integration, which really came to an end next year, and the technology program, which Ping will talk about a little bit in a moment, and I'll just touch on the next slide. Our focus really now is to really dedicate ourselves to business development. We believe we've set ourselves up really well with market-leading positions, market-leading technology, and deep experts at scale in all of the business units we want to have there. So we're really going to focus on business development. The business development team there, and I've got estate planning, as I said, because we do view that as distribution. That is our commitment to distribution, is across the top part of this diagram. Does rely heavily on those SMEs that sit within all of those teams, because the business development will work with the lawyers, say it's a health and personal injury claim through that 5 to 10 year period where the compensation award plays out in the courts. But when the money is awarded, or just prior to that money awarded, the family do want to meet with the person who's going to be their relationship manager day to day. And that is a critical part of the sale. So having local people on the ground in all the jurisdictions where that legislation applies, who can work with the families one-on-one and have that really seamless handover from the business development manager, is critical to this success, and is absolutely one of the key drivers of why we're having so much success in that health and personal injury space. As you can see there, we work across a lot of different professional service providers. We've got great networks in all the capital cities, and we believe that we have an unrivaled set of traditional and contemporary private trustee services, and the best team delivering them out into the market. An important part, which Darren will talk on in a moment, but this is where we allocate the fund that we look after on behalf of our clients to our own internal asset management capability. So working through that, obviously the business unit there on the left-hand side, the fund associated with the business unit in the next column, and then the current asset allocation to our own internal asset management capability. And the right-hand column there is how we see that allocation moving in the future. So you can see there it's very diverse. In some cases, 100% of the fund is invested for individual clients in our own investment products. In other cases, none of it is. And that is because every client is managed individually, and we take into consider their interests first, and then align what their interests are with the best investment solution for them. And quite often that is obviously with our own investment products, for some of the reasons I've touched on today, that need for separation of capital and income, or maybe the tax-free status of the investment. But there are times when we need to select other managers too. And then just quickly on the technology place, we have invested heavily at EQT and primarily within the TWS business unit over the last 3 years. But we've now got ourselves to a position where we have market-leading technology supporting our business, which is an absolute change from where we were. We've got client portals on all of our core platforms. This enables beneficiaries to self-serve, creates a much greater user experience, and also better for our staff as well, because they can do more of the value add stuff rather than static data changes, for instance. We're developing the ability for straight through processing of applications and payments, and that'll be complete in the second half of this calendar year. And we are building out embedded workflow processes, which will also be carried out in the second half of this year. So we really are now in a position where we have the best people and the best technology to support our clients and our future clients. And then just to finish, I think I've touched on it as we've been through all of this, but the tenure of our clients is long for virtually every part that of the clients that we deal with. Typically, we have a client from the time they become a client to the time they pass away. So most of our clients are with us for multiple decades, and it's really important that we're able to develop great rapport with them because of the length of that relationship, have teams with deep technical knowledge to be able to support them through that journey. And as Mick said, we don't really have outflows in this business. Just the income is spent typically on the beneficiaries, but the capital remains within our control until typically someone passes away. So with that, I'll pass over to Darren.
There we go. There we go. Thanks, Ian. I'm going to pick up on a couple of points that have already been made by Mick and Ian on the way through, and that asset management and equity trustees, what we're aspiring to do is to be an active, high-quality in-house manager that has a tailored solution for the specific requirements of our client base, and through that also provide some growth options for the business. Mick and Ian have already made the point that a core part of trusteeship is actually the stewardship of assets. So actually, there has to be a decision somewhere in the trustee chain about how to manage and implement assets. And about 7 years ago, the business took a sort of a deep dive into looking at what the best form of providing that solution was, and really took the view that to building and maintaining a quality in-house function was the best way to deliver on three key aspects for multiple stakeholders. Firstly, from a service proposition and in terms of giving the right outcome to clients, to provide both that tailored solution, deliver on investment outcomes, have regard to their specific needs. Having an in-house function was key to that. Also providing a service proposition to relationship managers and within the business. It's a high touch, high service function we provide in-house, something which is arguably difficult to replicate by using just external managers. Secondly, it makes good financial sense. Through providing this service, we're able to do it at a cost-effective level and actually generate strong margin for equity trustees, shareholders and other stakeholders. And finally, provides a growth option through building this capability in-house and servicing our internal book. We actually also do provide these services externally, and there's, as we'll allude to, as I'll go through, we already manage about a quarter of our book for external clients, and we think there's some growth options there as well. So through that, we think it provides a lot of value for all those different stakeholders. So currently we manage a bit over 6 billion, 6.1. It's a touch higher as we stand here today. And we do that through essentially a range of different mechanisms. We have internal strategies where we feel we have both scale and ability to deliver value and generate above benchmark performance in those asset classes. But where we don't have scale or capability internally, we use external managers or options. So we use a variety, a hybrid solution to bring that to bear. We think our key capabilities are a highly experienced and capable team in our areas of specialty. We have a specialist focus for the four purpose sectors. So that cultural alignment and the ability to speak to and communicate both internally and externally, we think is a core skill set. And we do think that the way we manage money does actually have application externally as well. You know, that growing real value of capital over time, income-centric nature, we think will speak to a lot of demographics, you know, the retiree market and so forth as well. So we think it has application beyond, obviously, TWS or equity trustees. So the team won't spend too much time on this slide other than to say we feel we've got a really strong team. A lot of the people who are there actually were there when Chris and I joined the team back in 7 years following that review. All of the team is still in place and we've built upon that. So we've strengthened our Australian equity team, although it was already had strong capability. We've added to that through portfolio management skills in defensive asset classes. We've brought responsible investing and integrated that and uplifted the capability there. And we've got really experienced client service personnel. So we continue to build that and have a staged investment over the last 6 to 7 years, and we'll continue to do so. So just a little bit more detail about how the funds are managed. Of the 6.1 bill, as I alluded to and Ian's touched on, about 3/4 of that is managed for TWS and 1/4 is managed for what we would call external clients. So that's where the only relationship those clients have with equity trustees is us as an investment manager. So that's an independent decision to take on our investment management skills. Of the 3/4 that is in TWS, that blue box is not quite to scale. The vast bulk of that is in the PCT and endowment space. Ian's already given you an indication of the percentage that's managed in the various cohorts. Probably about 80 to 85% of our TWS fund is through in that PCT endowments. Now, the characteristics of that is that, as has already been spoken about, it's very stable. There's not a lot of inflow into that business because a lot of those clients are no longer with us, but nor are there outflows, and it's very stable. As an investment manager that's managed money in a lot of different environments, corporates, boutiques, and so forth, having a stable book of fund that we can actually set long-term investment agendas is really appealing. We don't have the risk of those clients calling us up and taking away money, so we can really set and invest for the long term, and we're able to generate strong margin on that. So that sort of underpins much of our core strategy and how we implement. But I'd also call out, and as Ian also touched on, there's a couple of opportunities within the broader book. Probably most attractive is the health and personal injury piece. Of the 4 billion that's in that book and the 2 billion that's non-advised, there's already an appetite to align with recommended models that are provided or recommended to the trustee by the asset management team. That incorporates a proportion of in-house product, somewhere between 27% and 33%, depending on the strategy and the client cohort. So, you know, it does have a lot of other external managers and diversification by manager and asset class. But we also think there's opportunity going forward to perhaps provide an active asset allocation solution for that cohort as well. But we'll be investigating that as we go forward. But also that book will continue to be penetrated as that client base, particularly the AET acquired book, aligns with the EQT methodology over time. There are constraints around doing that in one hit. The trustee has regard for transaction costs, CGT and others. So that transition is occurring over time. So a lot of those synergies have been obtained, but there is still more to come. And the other piece that, you know, other two elements, which I think are really attractive opportunities, the active philanthropy space, Ian's mentioned around the IFI initiative. I think that's a really exciting opportunity. We manage the book a bit, unless the client chooses to have their own strategy, the default is for us to manage that money. And the native title space, where we've got currently low penetration, but we think there's opportunities there as well. The core of the book that's external is in probably three key areas. We do manage money for a superannuation client, a key superannuation client. We also manage money for about 35 not-for-profit and charitable organisations, again, that often have very similar underlying investment objectives to our TWS cohort. We have a very strong philanthropy team within TWS, so the networks and the contacts and the, I guess, just the cultural piece that fits with that is very powerful when we go to market and we look to present a holistic solution to that not-for-profit mandate space. We'll look to provide an investment solution, but also be able to talk to how we can help that client in other ways in and around networking and fundraising and other capabilities. So we think that collective capability is a real asset, which we'll increasingly look to take advantage of going forward. So how that sort of translates, the underlying asset pool sort of basically reflects, as you would expect, the investment objectives of that client base. Historically, much of the perpetual charitable trust and endowment funds, certainly those that inherited, that we picked up as part of the ANZ trustee acquisition in 2014, many of those portfolios were actually all Australian equities. Now, Australian equity still remains a key foundational element of many portfolios, but we are reducing the reliance on that. The reason why it's, obviously has been a core component is that underlying philosophy of maintaining the real value of capital, but also having regard to income and tax effective income as a component. Generally, these clients have commitments over multiple time periods, whether they be granting, whether they be operational. So essentially having that dual focus around capital maintenance and growing capital, as well as income generation, is key. So hence the 58% that sits in our current book in Australian equities means that is a really key asset class. We're really fortunate to have, I think, a really strong process and team in that space. Chris Haynes, as I mentioned, we joined nearly 7 years ago. The quality of reasonable price investment methodology is really consistent with our underlying client base. Prior to Equity Trustees, Chris and I worked together and had, I think, a strong track record in implementing that process, and it's continued on over the last 6 years of above benchmark performance, good risk metrics, and delivering on those client outcomes. And importantly, we've elevated the level of responsible investing that we've integrated across the book as well, which again is key to a lot of our client base. We're members of UNPI, as everybody is, and we've had our products RIA certified as well. So, continue to evolve that capability. In some of the other asset classes, we've incubated and we're building out new strategies. In the international equity space, fund that's been going for over 3 years, EQT 8 Bays. It's an industry-driven, using industry ETFs to drive, I think, a really differentiated strategies, generated top quartile performance over the last 3 years. So that's really served our clients well that have been invested in it, but we still think that has opportunity in the broader market. And we've also added in the defensive asset class to our fixed income and mortgage strategies, a low duration credit fund, which again has got good long-term performance and we think has further growth capabilities. I also probably would point out the 23% that's in cash. There's two elements to that. There's an asset allocation element of cash, but a lot of the TWS book use that as the effectively working capital. So that is, again, a very stable book of business, nearly $1.5 billion in that book. Again, attractive margin, very stable. And I think that's probably got growth options as well. Just touching on, so outside of TWS, which we think will continue, as I mentioned, continue to grow organically at the rates of TWS, but with some penetration upside. The charitable and for purpose market, we think, is a real opportunity for us. As I mentioned, we've already got a number of clients in that space. We manage money for over 1,000 charitable trusts. There's a very strong, broader EQT network that we can leverage off. And that is a very deep market. It's obviously, there's a lot of charitable organisations. We're really only looking to play in the upper end of that, the top 3,000 organisations, where we'd estimate that on average, the sort of the investable base, so that's when you take out property and various other pieces that are probably unlikely to be invested, probably averages around 15 mil for a large number of clients, opportunities. And that's probably our sweet spot, somewhere between the big asset allocators and above, I guess, your sort of traditional advisor market. So that's where we feel that's probably our sweet spot, and where, as I said, we have really deep networks. So obviously it takes work to access that market, and obviously we'll be putting additional resources into driving that. So just in summary, across the book, it's a really stable but diversified book of business. We feel we've got a really strong tailored proposition that is fit for purpose for both TWS and EQT, but also has application outside of our business. It's grown at a compound 14% over the last 4 years, and we think there are really strong growth options over the coming period, both through TWS-driven business, but also market penetration into other client segments. So I'll leave it there.
Thanks, Darren and Joe and Ian. Ian, do you want to just, Darren, just stay up here and we'll stop now just for 2 minutes and grab questions for Joe, myself, Ian or Darren, and before we then go on to Andrew Godfrey covering the corporate lines of business and the other parts of the business. So any questions, any of us? There's a microphone if you need, although probably the room's small enough to yell, but. Oh, okay. All right, cool. All right, we're recording. So yeah, we'll get it on the microphone. So Morgan, would you be able to just walk the microphone around if people need it? Yeah. Thank you. Right.
I know to help warm up, I know there was a question regarding the AUM chart around did it add? And just to clarify, it does. The asset management fund is sitting in the TWS fund that we showed in that 4-table graphic.
Thank you, Joe. Michelle. Yeah.
As a trustee of People's Capital, how do you manage your two stakeholders, the shareholders who want a decent return and your beneficiaries? Because you mentioned attractive margins in one of the presentations. So how do you get that balance?
Yeah. Well, I guess there's a couple of things. One, that, we're in a competitive market. So, we need to price services and products competitively. So there's that. We also have a view as to, what is really an acceptable margin. We don't have products that have, giving us margins up over the 50% type levels. I think, we'd be getting into a space there that might make us feel not so comfortable. And I guess the other thing is that all prices that people commit to, are basically public prices. So they're in the PDS within superannuation and the corporate trustee services area. And in respect of Ian's area, they're published on our website, and so they're known in advance. They are the prices, though, at a point in time when someone dies, right? So that is what the commitment is when people appoint us into an estate plan. So but that's normal industry trustee practice. So I think, I feel we've got that balance right, but probably don't expect us to deliver 80% type margin products. That wouldn't really be aligned to what we're trying to do for beneficiaries here. That answers it. Yep. Alex, you had a question? Oh, sorry, Dee, did you have a question? You got the microphone. Oh, you go. You got the microphone.
If just going back to slide 33, so I think it was mentioned health and personal injuries, one of the areas where you're looking to internalise more of the FUM. Can you just talk to maybe a couple of things? The first thing is what steps are required for the FUM to transition to internalise and how long that will typically take? And then do you have targets of where you want to internalise through each of those segments? And then lastly, just the revenue uplift or the margin uplift that you may see when you internalise that.
Sure. Okay. I might let Ian cover the process of decision making that we go through, and then I can sort of talk about where it may end up eventually. Yeah.
Yeah. Thanks, Mick. Can people hear me okay with this mic? It's picking up? Yep. Okay. So there's the health and personal injury clients are broken up into two segments there, advised and non-advised. And the key difference there is where it says advised, we actually work with external financial advisors. So they determine effectively how the money should be invested, and we sign off on it. So that's not money that typically we manage in-house. The money that we manage in-house in this space is in that non-advised section. So we're both the investment manager and the trustee there. It's also important to note that in all of these fund values, we carry about 1,200 properties with a value of about $1 billion. That's included within that fund. And a lot of that fund does sit in this health and personal injury. So there's about $700 million worth of property in that combined fund sitting there. So obviously that's people's homes, so that won't change. So the process is so Darren's built a product that we believe is fit for purpose for well, it's not a product yet, it's a portfolio, sorry, a multi-manager approach portfolio that we believe is fit for purpose for clients in this sector. So we will align them with that investment strategy unless there's a reason not to, whether there's tax or other reasons that they might have. So for instance, if a family is, so the longevity of these clients is typically multiple decades, but unfortunately some clients might only have a few years to live. So they would have a more conservative portfolio. But assuming they fit the bill of a normal client for us in this space, which is multi-decades, then we would align them with our investment philosophy. And maybe I'll get Darren to talk about the construction of that portfolio, which really shows what that 27% is in that bottom portfolio. We are then looking to develop that and actually work with the advisors who work in this space to think about utilising those products as well. But we do have to consider tax, transaction costs, whether it's in superannuation or not. So there's a lot of, and every portfolio is managed individually, and every decision is made with that client in mind. But if we believe it's possible, then we do look to move into our investment strategy, which is with that sort of 27 to 33% in our internal product.
Thanks, Ian. Darren, did you want to add anything to that?
No, only I think that's a key point of your question. It's probably somewhere between that 27 and 35% would be in internal strategies under current model. And important to note that is diversifying away from just Australian equities, and particularly the defensive asset classes, where we can demonstrate that we're producing and can produce, you know, after fee returns commensurate with external managers, and it's probably lower beta versus, you know, in terms of performance delivery versus external managers. So I think that's the opportunity. And what we're exploring is really, I guess, turning that model portfolio into something which is a bit more dynamic asset allocation, and where we can ideally, you know, I don't think it's too early to talk about this, but potentially look to take a reasonable asset allocation element of fee around that, but ideally compensate that through, I guess, buying power in terms of the external manager part of the portfolio. So the client's no worse off, but gets a more dynamic asset allocation and management through the period. So that's the next leg of growth we're looking to optimise.
Thanks, Darren. So Dee, we haven't answered exactly your final question, final part of that question, but you know, I think what Darren is saying on where we're completely controlling it, moves to our investment program, we're typically going up to about a third, is basically where we are. I think increasingly over time, Ian's making the point that the model that AET used, where they had advisors giving them advice, that's really not the model that Equity Trustees have used in the past. Now, I'm not saying we'll change that model, but we will think about it, because it's not the way we run the rest of our business. So we'll see how that goes over time. Yeah. Alex.
Oh, thanks. My question is more about the TWS business. I guess go forward 2 or 3 years, you made the investment in technology. Where do we see sort of big growth the next 2 to 3 years in that business? Is it more in advice, getting more advisors, or estate? Where do you see a sort of growth profile from the benefits from the investment in IT?
Yeah, so we've had strong growth over the last sort of 12 or 18 months, as well as going through the AET integration, particularly in that health and personal injury space, and we see that continuing. And we'd like to think, you know, as we get bigger and better in that space and the technology improves, that we will win a greater share of that market going forward. Native titles, as I mentioned, we've won 3 this year, which is a significant amount of clients to win in that space in any year. So our market leading positions, I believe, will give us enhanced growth going forward to that we've had previously. From a technology perspective, as Mick said, and I touched on, we don't really get inflows from our existing clients. So we're not going to get a lot of growth from our existing book of clients, but we do believe the technology is going to open us up to new marketplaces, for instance, the iFi technology and opening up that digital space. So we do see there's real opportunities off the back of that, the success of that product, if and when that is successful, of using that capability across the other platforms that we're using, NavOne and Hub24, to create other digital products for some of our other traditional trustee services. So we believe we've got, you know, we're better positioned than ever in our normal growth prospects, and we have got the technology now to potentially open up some new markets for us, which we will take a very cautious approach to, because it's a big change, but we're starting with the IFI, as I said, in sort of 6 weeks or so.
Thanks, Ian. Other questions? No, all right, we're right on time. I can't believe it. 10 past was when you're scheduled to come on, Andrew. So thank you, Darren. Thanks, Ian. So we'll hand over to Andrew Godfrey.
Good morning, everybody. And just to reiterate, thanks for investing some time with us this morning. Wanted to do a little bit of a deep dive into corporate and superannuation trustee services. And you're going to hear me talk about 3 themes quite consistently, which is one of growth, one of scalability and efficiency, and one of capability. Particularly on the growth side, when I think about our corporate book or our responsible entity, custody and debt and securitisation segments, we continue to grow very, very strongly. We grow strongly via new clients, and you'll hear a little bit later on, but so far in financial year to date, we've onboarded 47 new schemes. We've got another 26 schemes that are currently in implementation, and that continues on the strong growth from the prior 2 financial years as well. We've also been ensuring that the clients that we are bringing on board, the investment managers, are of high quality, and that is leading to strong inflows into those clients, which has been a major source of growth for us as well. We continue to grow in the superannuation segment, and as has been mentioned, that has been added to on the 1st of March with Perpetual coming on board, which represents about $6 billion of FUM. And with the continued change in the regulatory environment, we see strong opportunity for future growth, and I'll expand on that a little bit later as well. And we're also excited by the opportunity to grow in the small APRA funds, which are in essence are self-managed super funds with an independent trustee. There are 600,000 self-managed super funds in the country. There are now currently 600 small APRA funds in the country, and we think there's a missed opportunity, but a significant growth opportunity for us in the future as the only trustee that is providing those trustee services to small APRA funds. We talk about scalability and efficiency, and that is ensuring that we are growing well, and the investments that we are making in further data capabilities, in the automation through workflow, and also client servicing capabilities is a key priority for us going forward. Importantly as well, given the environment, and it's not a day goes past that we don't hear about it, but the strengthening relationships that we have with regulators is a daily experience for us as a trustee. And that's something that from a capability point of view that we're continuing to enhance and mature our approach in relationship with the regulators. We do have a stable leadership team with deep core expertise across all the segments that we do operate in, and that team has been stable over the last 12 months and will continue to be so. As I said, a continuing growth story right across all the segments that we do operate in. We have on the left-hand side, which is our corporate or our responsible entity, is the main area that we're focused on there. As I said, 47 new funds established year to date, 26 in implementation. That follows on from 66 new funds that we onboarded in the previous financial year in FY24. And if we go back to FY23, a further 40 funds were onboarded in that period of time. The emphasis there is we're starting to really see the flow-through benefit of the quality managers that we have been tasked with being the responsible entity for. Strong quality managers, which we'll show in a moment, that really are really being successful, and their success is helping to drive our success in that corporate market. We're seeing strong growth in listed vehicles, particularly in ETFs and also in listed investment trusts, and we've done quite a number of those in the last quarter alone. And in our smaller segments in custody and our debt and securitisation business segments, we're driving revenue growth of 30% over PCP, which is very strong, albeit off a low base, but we see significant growth opportunities, particularly in the custody space, aligned with our clients in the responsible entity space going forward into the future. On the right-hand side, you'll see the growth in superannuation, very strong growth from a FUM, as you can see there, that when you look back to FY19, to where we are today in terms of, with the addition of Perpetual, close to $80 billion in funds under supervision. So from a trustee perspective, I think that puts us in the 9th or 10th in terms of the level of funds in the superannuation industry. And we see strong future growth opportunities, albeit the number of funds is reducing as each year does go by. But we do see strong opportunities for growth in the superannuation segment going forward. Sorry. I've mentioned a couple of times in terms of the strength of the partners that we do deal with, and it's been a very deliberate strategy from us over the last number of years to make sure that the only people that we do provide trustee services for are quality partners that we want to partner with, that have good growth potential, but also mature in their outlook. And so we have seen a little bit of a reshaping of our book, where not only have we onboarded some great brands, as you can see there, in terms of Australian fund managers, global fund managers, and also the superannuation providers, but we've also been exiting some challenging relationships as well, that we've wanted to ensure that we don't have an enhanced level of risk with counterparties that are not at the level that we want to be partnering with. And interestingly, where you see Realm, HMC, Talaria, Perpetual, great brand names within Australia that have all been onboarded in the last quarter alone. And so we're continuing to see great growth, great brands, great organisations to partner with. And that actually does obviously aid our growth going forward into the future. We also partner pretty much with all the service providers in the network. So whether they be custodians, auditors, unit registry administrators, prime brokers, market makers, and insurers. And that's adds a little bit of complexity to the business, but we have strong processes to oversight all of the provision of services to all of our clients. But importantly, the relationships and partnerships we have with those service providers is an important referral service source for new business as well. And so we work strongly with those service providers just to, obviously in the service delivery to the underlying investors, but also in terms of helping us to continue to grow. So I'll just deep dive into super a little bit. We are the leading independent superannuation trustee in the marketplace. We are different in the marketplace, where the majority of funds have a one-to-one relationship, a single trustee to a single fund. We are a trustee to currently, if you include Perpetual now, 12 superannuation funds, approximately 80 billion in funds under supervision. And that covers funds across the spectrum of platform-based funds, life office funds, master trusts, and also small APRA funds. A key component of that, and a key component of the growth, has been the really strong performance of HUB24, which you would have seen. In the last financial year, their growth has been approximately 25% on a fund basis, and we continue to partner very strongly with HUB24, not only in the corporate business, but across our business at Equity Trustees as a whole. Our strategy in this space is no different to what we talked about last year, and that is that we want to continue to partner with strong superannuation funds that are in growth. All of our funds are generally in positive net cash flow, which is strong from the funds that we do provide services to. So we continue to benefit from that growth. We also think that there are many further opportunities for us to grow through new appointments as trustee to superannuation funds, particularly as the regulatory complexity continues, that the amount of time and effort that is going into managing regulatory change, managing regulatory interaction, we do see further opportunities for us to become trustee for other superannuation funds within the industry. We've talked before also around, and I mentioned before, around the small APRA fund market. We are going to revitalise the proposition that small APRA funds that we inherited from the acquisition through AET, plus recently through Perpetual, who have the other remaining small APRA fund book. We think that there is a strong market to grow in the small APRA fund. As I said, there are 600,000 self-managed super funds. About 20,000 self-managed super funds terminate and wind up each year. Many of those wind up because the trustees of that self-managed super fund become incapacitated or unable to continue to be trustee. There's really little awareness of the opportunity to transition to a small APRA fund, being the only trustee and provider of small APRA funds in the marketplace, through the right product settings, through the right relationships with those that are in the self-managed super fund market. We think that there is a very strong opportunity for us to grow in that segment, and we're working through that as we speak. Continuing to build scalability and efficiency in super is very important, particularly through the use of data. How do we manage our risk effectively through the use of data across our client book is becoming increasingly important. There's a large, as I'll mention in a moment, there's enormous amount of regulatory change and uplift in prudential standards in superannuation occurring at the moment. And that is obviously a key, a lot of work for us at the moment, but also represents a key opportunity because all of the industry is going through that regulatory change, whether it be the implementation of FAR, CPS 230. I could rattle off another 6 prudential standards that are being uplifted this year. And that is causing obviously a lot of work for us to deliver that change, but it also represents an opportunity with other clients who are also going through that change. Maintaining constructive relationships with regulators is continuing to be of criticality. We've got a very productive relationship with ASIC, with APRA, with AFCA, and we continue to partner well with them in terms of our model, in terms of the services and trustee services that we do provide. So our value prop in super, and why are we confident that there is growth? There is a lot of funds still out there, and I'll show you a slide from a report that was recently released that are navigating their way through the current challenges from a regulation point of view. And the value of an independent trustee to manage that for them is something that is very much valued by those clients. And we see that as I said, an opportunity for us to grow significantly in the future, more than likely a smaller number of appointments, but of significant size. So as we said, we've got 12 superannuation funds at the moment. I don't expect over time that number to increase, but I do expect there will be change within that portfolio, and the clients that will come in will be of significant size, particularly in the large retail segment that we think is where the greatest opportunity lies. I thought it's worthwhile. This was a report released by Mercer in the last couple of weeks in their Shaping Super. And it really does show where the growth is. And this impacts not only in the superannuation space, but also has a flow-on impact into our corporate business from a responsible entity point of view, is the growth in assets forecast to be 10 trillion by early 2040s. But they're also showing the reduction in funds. Their view would be from the current 89, of which we have 12, down to 20 in 2049. There's no doubt that there will be consolidation over that period of time. One could debate the pace of change as to how quickly or how long that may take. But there will definitely be consolidation as time goes on. But I think what is important is 2 points. Is one, the role that an independent trustee can play in that change. And I think we are positioned very well to take on further trustee appointments over that period of time. The second point that I'd make, having been in this industry for a long period of time, what I do know is that the next 5 years, it may not look the same as what it is today. And definitely in 10 years, I think that there will be significant change that will continue to occur in the sector. And as I mentioned, regulatory change continues at a very fast pace. We're in the middle of that this year in terms of implementation of operational resiliency standards, CPS 230, financial accountability regime, which came in on the 15th of March. There is uplift to standards. I won't go through the detail of them all, but 515, 114, 530, 190, 900. There's a lot of numbers. But a lot of work goes in terms of the uplift prudential standards. And as I said before, whilst that generates a lot of change for us in terms of the work that we need to do, it also represents an opportunity for future growth, because those organisations that are still running their own trustee company in-house their continued need, if you like, to focus on what their core business is, distribution, brand, servicing of members, gives us an opportunity that we can be the independent trustee for them, which takes that burden in some respects away from what they have to experience each and every day. What we haven't put up there is you will have seen, particularly in recent days, there's a significant amount of attention being provided by government and also regulators through ASIC around member servicing standards. And I think over the next couple of years, that is going to significantly increase as well. We're going to see a lot of attention paid to that, quite rightly, looking at the actual underlying members in terms of the services that they are being provided, initially focused around death and disablement claims handling. And that is something that we think represents, once again, opportunity for us to leverage our independent trustee capabilities. Shifting to corporate. As I said before, we continue to grow very, very strongly in the RE space. And as we said before, 66 new funds implemented in FY24. We've continued that with 47 funds already implemented in FY25. We've got a further 26 being implemented at the moment, and a significant pipeline of new opportunities, both in terms of new managers, both domestic and global managers, establishing new schemes, along with our existing client base who are implementing new schemes as well. And so, importantly, as I said before, the strength, the size, the capability of that new client base is really paying dividends for us in terms of growth. And we're also very focused on ceasing problematic relationships that we've had in the past, where there's been a disproportionate level of service having to be provided to problematic clients versus the new clients that we're really wanting to make sure that we are focusing on. So there you can see that the distribution across our responsible entity clients, or our fund services clients, and the funds under supervision we have. We also, in the middle there, the custody and real assets, we see strong opportunity for growth, that we have seen strong opportunity for growth in that segment, in terms of both the investment that we are making in capability to grow that segment, the opportunity for us to expand the service lines with our rest of our client base who have real assets that we can provide custody services over, and we see continued strong growth in that space. We thought it'd be worthwhile just giving you a bit of an overview of the composition of the portfolio particularly across the fund services or RE business. You can see the manager locations predominantly in Australia, but increasingly significantly globally as well. Our asset allocation has changed over time. We're getting significant uplift in private credit and also in fixed income over the recent period of time. And also, as I've mentioned, significant growth in listed vehicles. You would have seen we have been the RE for the Digico REIT, for MA Financial, for Realm, and we have another LIT that is currently under implementation. Significant increase in the level of ETFs that we are onboarding as well. 8 ETFs in the first half of the financial year. We've got a further 5 ETFs that are currently being onboarded at the moment as well. So really strong growth across the fund services business, a very diversified book of clients, both locally and globally. And we're seeing a really changing nature of the types of funds that we're onboarding over the last number of years. I've talked a lot about this, the growth, the scalability and efficiency and capability. We see growth in the fund services business, not only from new clients, which has been evidenced by our growth rates over the last 2 to 3 years, but also because of the mature clients that we are partnering with. We're really seeing strong growth, and their success has been helping us to be further successful. We see opportunities. Whilst we are the largest and the leading provider of responsible entity services in the marketplace, we are relatively small when you look at the entire responsible entity and the number of responsibility, number of schemes there. And we think there is opportunity both either through change in regulation in terms of independent responsibility services. We think that there is a strong opportunity for us to access more of that market. Similar with the value proposition in terms of we think there is an opportunity to create material reduction in risk for investment managers, cost reduction. There is increasing, as Mick will allude to a little bit later, increasing regulatory activity in this space through notices, through thematic reviews, one at the moment in terms of private credit that is happening at the moment, that we think that there is strong proposition for us to continue our growth story going forward in the future. So in summary, we are the market leader across superannuation trustee and responsible entity services. Our growth continues to be strong and builds on prior years, and we are seeing that continue into the future. We see further opportunities in various segments, whether it be enhanced growth in custody, whether it be enhanced growth in our small APRA funds segment, and importantly, to ensure that we manage that growth successfully, there will be a continued focus on scalability and efficiency. So with that, I think I'm handing back to you, Mick.
Thanks, Andrew. I'm not head of the HR function or the risk function, although I am acting in that role at the minute. But I am going to talk to you about people in the organisation. I didn't get Georgie Taylor, who's our EGM people, to come up, given us just a couple of slides. And so let me start on the people front. I think the first thing to say is that I mentioned before the purpose of the organisation, and it is a company with real purpose, and therefore we attract people who effectively are motivated by that, right? And also it means for many people it's a vocation. So the turnover generally in the organisation is not as high as what you might see in other financial services organisations, and the type of people we're looking for need to align with our culture. We've got three clear values in the place, and we've had these, consistently for many years. The first is trusted. It's in our name, right? When people appoint a trustee, right, they generally can't get out of it after that. So you've got to trust the organisation, and you've got to have confidence they're going to be there in the long term. So trust is critical. Accountable. There is so many obligations on a trustee, and increasingly so in superannuation, and a bit less in funds management. So we are very focused on ensuring that we are carrying out all of our duties as we need to, and empowering. In some cases, we can empower our clients. So that's effectively what we're doing in superannuation and corporate trustee services. We're trying to do that in trustee wealth services, but sometimes we can't, and we've got to completely control a client's outcome. But one of our values is where we can empower our clients, we will be seeking to do that. So the people strategy really is about ensuring that we retain and attract great people, and they need to be people who have got deep domain expertise. They need to be people who've got significant experience in the industry. So, and that often might mean we get them from our competitors, but generally what it means is we're getting them from other parts of the financial services industry and needing to train and develop them in trusteeship effectively. So it's really important, the succession that goes on in this organisation, and both, in the two key business lines under Andrew and Ian, we have got a great leadership team underneath of very experienced people in the industry. I think increasingly over the last 3 to 4 years, we've been seen as an employer of choice. I think that comes down to a couple of things. One, that the business has continued to grow, so it's attractive proposition for an employee from that perspective. I think also just the singular focus on trusteeship means that people that have that bent, right, are basically attracted to the organisation, and the culture recognises that. So it's been a good period of time for attracting and retaining the people. We've got a pretty stable team in all these key areas. A couple of changes going on in finance in Joe's team, and also in our risk function. But other than that, it's been a stable period of time for us. Now, I just want to touch on the regulatory landscape. Now, Andrew sort of commented on it before, but I just want to look at it from a sort of a more global perspective. And the bulk of it is happening, the changes are happening in superannuation and in corporate trustee services. So the first thing is that supervisory intensity is just increasing all the time, right? And this is really an opportunity and a risk for us. I mean, we have to manage it very carefully ourselves. There are multiple thematic reviews being undertaken by the regulators. Now, they don't end up with any sort of action being taken against particular participants, but over the course of a 2 to 3 year window, there will be change following those thematic reviews. So if you like the private credit review that's going on at the moment, we won't see the outcomes of that for a year. You won't see regulatory change for another year after that. So you've got like a 2-year window from those thematic reviews coming through. The frequency of notices to produce. So both regulators have powers to force you to produce information to them. ASIC is probably the more dominant player in doing that. And the frequency of those notices and their time consuming, right, is increasing all the time. Their investigations that they're undertaking, generally as a result on the back of those notices, are increasing. There's intensity of just general supervision and wanting to be, having constant communication to them, particularly APRA, where we run a relationship model with them. ASIC doesn't quite run that type of model. Court actions, mainly by ASIC. And many of those have resulted in financial penalties, and in some cases, financial penalties without court actions. So that sounds not so good, when you listen to that. But the reality is, it's why people appoint us. So when they appoint us, effectively, they're transferring some of that risk. When they transfer the risk in our hands, the risk is reduced because we're independent. So we're not likely to be making the same sorts of decisions and errors that they may make if they're running their own business and they've got an in-house trustee arrangement. So that's one reason why the risk reduces. The second reason is we're experts in this area. This is what we do, right? This is all we think about doing, okay? And all of our clients generally, they're not experts in this area. They're actually in business for something else, whatever it may be, funds management, administration, advice, whatever it is. So the risk reduces when it transfers to us. So we primarily look at this and say, this is an opportunity. Sure, it elevates our risk, but it's an opportunity. And it's why the business is growing so quickly. I think Andrew mentioned most of the regulatory changes that's afoot. I won't go through that list, but it's a long list. It's primarily in the superannuation side, more so than fund services, but the intensity of activity is primarily being driven by ASIC on the other side, both in super and in fund services. And there's a number of other changes afoot, not related to each of those, but the government's Productivity Commission review that was delivered about 9 months ago. There's nothing in that that's sort of unfavourable to our business, and the objectives of the government there are to double philanthropic granting over the course to 2030. So it's a positive, if you like, tailwind to the business. And Treasury is still in the process, 18 months into doing a review of managed investment schemes and how they're configured in the Corps Act, the way they were originally configured, some 25 years ago. That's sort of gone into a black hole. We don't see favourable or unfavourable change there, but are seeking to, we've made submissions in that space and are seeking to see whether we can actually get some change that is favourable to the business. So that's the regulatory landscape. Risk management, it's critical to us. We run effectively our classic 3 lines of defence model with a centralised risk function in the middle and a risk function in each of the lines of business within asset management, within trustee wealth services and corporate trustee services, and all parts of the support parts of the business as well. And then internal audit. I guess what's different for us is the first line is very risk focused. So the bulk of the work goes on in our business units, right? Because this is core to our business. So it's not something that's additional and different. This is what we do basically, is we're constantly looking to minimize risk for our clients and for ourselves. It's really underpinned by the foundations of the culture of the organisation, the governance structures that we have, and also the operating models that we have. They're a little complex, but we leave nothing to chance in making trustee decisions, basically. I'm going to hand over to Ping to talk about technology, and then we'll stop and have questions after Ping has spoken. So over to you, Ping.
Thank you, Mick, and good morning, everyone, and thank you for the opportunity to talk to all of you about technology today. I'm predominantly going to update everyone on basically where we are up to with our technology transformation program. You've heard a little bit throughout the morning about the things that we've been doing. I'll give you an update and a little bit of a view as to what we're thinking about doing in the next coming financial years. I'll start by going through a couple of more foundational pieces for those that were here last year. We went through very similar slides here. We've got fairly clear principles as to how we approach our technology journey at Equity Trustees. And these are principles that we've stuck with throughout this journey of ours. It can certainly be demonstrated through the program of work that we've done over the last 3 years, where we have implemented the likes of Workday, Quantios NavOne, and REN's iFi platforms. And why these principles are really important for us is it allows a fairly reasonably small team to focus on the areas of technology that we can really make a difference and enable the business on. These are the 3 areas that we do focus on. As I said, these are the areas that I think we can add the most value and are fairly unique to Equity Trustees as a business. For example, with the client and user experience, that's something that we want to own, right? It's aligned to our brands, aligned to the way that we want our clients to experience our services and so on. So we want to own that. As you have heard throughout this morning, we are market leaders in many lines of our businesses. So we do believe we've got unique business processes that really work. So we have to own that. We have to make that as scalable as possible, as efficient as possible. And then finally, in the data analytics space, we've got a lot of access to information across the lines of businesses. Some of the lines of businesses have been around for a very long time. So again, we're in a fairly unique position where we can make the most of all the data that we've got. So the principles and the way that we approach, I suppose, the technology journey at Equity Trustees is very important to us. And I'm in an incredibly lucky position that I lead a team that actually are very aligned to those principles and areas where we can add value. Similar to my colleagues this morning, we've had a very stable leadership team. Again, most people, if you remember from last year, the faces are the same, with the exception of Chad Carroll on the right there. Chad's joined the tech leadership team from AET. As you can see there, his tenure with AET was 21 years, a long-serving employee. He's got deep trustee knowledge within business, and pleasingly, he's come across to the technology team, and his sole focus is on business processes. So we've added that capability within the technology team because we believe that it's important for us to actually do a lot more in the business process side of things. And again, you've heard from both Ian and Andrew this morning around why that's important. Okay. So I'll give you an update on our technology initiatives and where we are up to in terms of our program of the last 3 years. The 3 items on the left there are the things that we've been working on for quite a little while. And pleasingly, we're actually in a pretty good position. We're not far from completing all these activities and will be done by the end of the financial year. Working through them. In terms of Workday, we've got one last phase of implementation to go for our people team, and that will deliver additional functionality in talent acquisition and optimization, advanced compensation and learning for the business. This is currently on track to be completed in May. And the other thing with Workday, we've been on that project for a couple of years now. Pleasingly, it's been deployed across the entire organization. It's very much part of the overall employee proposition at the moment, and it's being used pretty well. Moving on to the new TWS platform, and Ian touched upon it a little bit. We have one last implementation or release of NavOne that's coming from our vendor Quantios. So that release is due in May to us, and we will be implementing that in July. That brings to a close a 3-year project for us to modernize the TWS technology platform. And again, that's been a bit of a journey for us. You know, we had the AT integration throughout that particular time. Pleasingly, again, you know, we were able to implement some of the AT's processes and technology as part of that. They had a couple of systems that had automation and straight-through processing that we were able to adopt and implement. So that's been a net positive. And ultimately, it really gives us a strong foundation for TWS to achieve the outcomes that we're talking about, the growth opportunities, the digital products, and so on. I will point out there, you know, a 3-year project is a fairly long time, and you know, you do go through your ups and downs with vendors and internal teams and so on and so forth. The relationships with our key vendors, you know, Quantius, HUB24, they remain really, really strong. You know, we're in conversations with them all the time, and certainly internally between the tech team and the business, that relationship has just grown stronger. So it's been a long but a really fulfilling journey for us, I think. Next one there, implementation of the iPhi or the Active Philanthropy platform. I won't go into too much there other than to say, you know, echo what Ian said. It's on track for mid-May release. It is a really exciting project for both the business and the tech team because it is, you know, truly self-serve, truly digital. And yeah, we're really, really quite excited about it. Moving on to the right-hand side of this slide, it's the things that are ongoing and, you know, things that we're taking forward into FY26 and beyond. So 2 main things there. I talked about this last time, cybersecurity. That's always going to be something that we'll focus on and invest in. You know, the business really is a lot more cyber resilient now. That will continue to be the case into the future. And it's really because everyone in the business really buys into it, management, our board, our staff, right? And we all think it's important. Now, it's part of who we are and a key part of what we can do for our clients. And then lastly, on this slide, we've got something new. So this wasn't on the slide last year, and it is, I suppose, the start for us working with CSTS on their data analytics journey and also their workflow journey. So we've started the first phase of this, where it is a data analytics solution, but there are components of workflow and automation in it. You know, it is a start for us, and we're expecting the first outputs from this particular solution to be live in June. The teams are actually currently in testing. So in summary, the program of work for us in FY25 is tracking pretty well. And at the same time, with most business and technology teams, we are starting to think about what we have to do in FY26 and beyond. And on that note, as I said, look, you know, with where things are at, it really does bring our 3-year program, technology program of work to a close come this end of financial year, right? You know, that means that we are pretty much done or finishing a period of buying foundational technology and platforms, you know, big platforms like Workday and F1. We are, you know, in the future going to work on things that are, you know, less foundational than that going forward. The technology investments will return to a much more normal part of our operating budget and reporting. And there will be a shift in our focus from TWS, largely in the past 3 years, to much more of a CSTS focus in the future. TWS, again, you know, you've heard from Ian, we've got the technology now in place, we've got market-leading technology in place. You know, we do have to take advantage of those platforms and really focus in on the digital opportunities there, the client experience and workflow and efficiencies for that business. So that's where we'll spend a little bit of time on. We will do various things in the corporate side of things, but there'll be small components. The real focus for us really will be CSTS, and you know, you've heard about the growth story from Andrew and the need to grow well. So building that scalability and efficiencies for CSTS in workflow and better use of our data and analytics capability is an important part of what we're going to do in the future. All right. And lastly, before I close off, I'll talk about our thinking in AI. not really a tech presentation these days if I don't talk about AI, so I feel like I have to. But in all seriousness, we have been testing out some AI capabilities and solutions. We are mainly working with our larger partners like Microsoft and Salesforce in the first instance. And I think we've identified a few use cases that appear quite exciting, and there's promise in it, which is amazing. The key here for us is we will really keep working with the businesses we have in the past, right? Really identify opportunities. I think the difference with AI use cases is they'll be iterative in nature. I think we've got to prove out value, got to prove that the solution can work, can prove that the solution will be adopted by either staff of clients, and then invest properly after that. So it's really slowly, and try a few things along the way. But it is an exciting technology, and we're certainly not going to miss out on that. So that's really all I had today. Thank you, and I'll pass you back to Nick.
Thanks, Ping. Thank you. I'm just going to finish off with an outlook. We'll then get Andrew and Ping back, and if you've got any questions for them on any of those issues and any general questions at all. So let me give you an outlook before just finishing. So firstly, we see a positive outlook for earnings growth for the second half of 25 and into FY26. The funds growth just in the last 2 months to February of 7 billion, so 3.2% is supportive of that. Of course, there's been a market retraction in the last month, so that will obviously impact, and we can't predict what that will be in the next 3 months of the year. At the half year, we announced aggregate expense reduction of $6 million for the second half versus the first half. We're on track to that. That reduction was broadly 50-50 between operating and non-operating expenses, so we confirm that we're on track to that. As Ping just said, the progress on the final stages of technology development are on track, and the last deployment of NAV1 in July. When I say the last, it'll continue evolving and developing over time, but the last that gets us to our steady state. TWS continues to grow, and particularly in the health and personal injury sector. Andrew mentioned to you the growth in CTS scheme establishments, with 47 so far and another 26 being in the process at the moment. So that's positive for future revenue. On the superannuation portfolio front, there's quite a number of changes going on. We mentioned the perpetual appointment at 6 billion and also continued growth in HUB24. We are also consolidating a couple of funds. And what does that mean? Well, it means the funds aren't sustainable. We'll roll them into other existing funds that we have. When we do that, the fees reduce because they're coming in at tail fees into these existing funds. No loss of funds under management, but there's a reduced revenue. So if you like, the net revenue increase of all those changes, think about it as about a basis point on a net 6 billion, if you think about it that way. And our strategy and focus remains as it has been. It's proving successful, and we would see that we will run that right into FY26 and beyond. So I'll stop there, and maybe if Andrew and Ping can grab a seat up there, and we'll get any questions for them to start with. And we're going okay on time. Actually, we went out to a Chinese restaurant last night, and I've kept my fortune cookie here because when I got the thing out of the fortune cookie, said, "Time is precious, but truth is more precious." So I think we're delivering on time and truth. So anyway, so any questions for Andrew or Ping? I'm not going to crunch on this because it won't be good. Yeah, Michelle's got the microphone. Yeah, Michelle, up here. We got my hand.
Thank you, guys. Just be interested to understand when you're trying to break the incumbency in the custody and debt securitization side, what the investment pitch is there, or are you kind of going for new clients and new opportunities?
Particularly on the custody side, there's a strong opportunity with existing clients that we're responsible entity for, that have real assets that we can become the custodian for. We haven't really tapped into that opportunity thus far. We're bringing further capability into the team. That is going to be a direct focus. Plus, there's just new opportunities that we can source that we haven't really tapped into. We've delivered really strong growth in that custody space. I'd say deliberately, but without the necessary investment in many respects. And we're now bringing further capability in that will have more business development in that space that I think we'll see continued expanded growth in there.
Yeah, the reality, I think just adding to Andrew's comment, the reality is once custody appointments are in place, very rare to change them.
Yeah.
It's too much legal work, it's too costly. Yeah, so it's always new appointments that we're looking for. Yeah.
And on just maybe if I'll close it just on the debt and securitization business, it's mainly that work is mainly driven through relationship with legal firms, which we have strong relationships with. It's a relatively small part of our book, and it's a challenging market in terms of the amount of market share that competitors have, and breaking into that can be quite challenging. But we still, even off a low base, we're seeing some very strong growth.
Next question up here, Andrew.
Not sure if this question's for you, Mick or Andrew, but I'm wondering what things you're doing to appropriately price for the increased regulatory intensity.
Yeah. So if I look at the superannuation segment first and foremost, we priced the uplift in prudential standards in this financial year. So we levied additional fees to cover the cost of that regulatory change. That will then flow through into future pricing for those clients in terms of the additional expense that we will incur as a result of the uplift in those prudential standards. So the work that we have to do in implementing and ongoing with the implementation of FAR, the implementation of Operational Resiliency Standards 230 will require additional resource and additional effort, and we are repricing as a result of that. On the corporate side, we have been doing a repricing, particularly of our legacy tail book within there, to make sure that we're remunerated for the risk that we're taking on and the value that we are providing. It's less of the regulatory is less of an issue within that book, but also the discipline around our pricing, ensuring that the services that we provide for the fees that we charge, that we're doing a lot more of, if it is outside of that fee basis, then making sure that we've got the disciplines in place of charging for that and being remunerated for the services that we provide.
Thanks, Andrew. I think I've sort of mentioned before that, perhaps some of our pricing in those areas hasn't been as sophisticated as it needed to be in the past, and Andrew's working on really upping that level of I guess, customization of the pricing effectively to the work that's there. Yeah. Other questions? Oh, Alex. Yep.
To Andrew, two questions. One, why do you think SAF's an opportunity for yourself? And yeah, because that's the first point. And I guess also in relation to the whole competition in the market, I'm curious how you picked up Perpetual Business. Are we seeing other opportunities where you may, within Perpetual, other situations you may lift out of business as such?
So on the SAF side, Alex, if we think about that number of 600,000 self-managed super funds that are in market, approximately 20,000 terminate each year, and then new self-managed super funds, a sort of equivalent number are established. When you look at the 20,000, a significant number of those terminate because there's an incapacity of the existing trustee to continue to operate the self-managed super fund. And often all that occurs is that the self-managed super fund is wound up, assets sold and transferred into a retail fund or an industry fund or a superannuation vehicle. And we think that there's an opportunity that an independent trustee could continue that investment strategy or the investments that somebody has in a self-managed super fund through to a small APRA fund. Part of that is building up the level of awareness. It was interesting, we took a brand position at the recent Self-Managed Super Fund National Conference. There's a low level of knowledge of SAFs in the marketplace, hence why there's only sort of 600 in the market. And we need to build those relationships with those intermediaries, brokers, advisors that are heavily working in the self-managed super fund space, creating awareness of SAFs. The initial reaction has been quite positive. And we think that there is that opportunity to grow in that space, and particularly as we're the only provider of trustee services for SAFs. Second question around the opportunities similar to Perpetual. There are remaining funds of the size of Perpetual that we continue to talk with, that they will be in a position where they may make a decision at some point in the future that an independent trustee model is the model for them. And equally, at the larger scale end of large retail superannuation funds, conversations in that space around an independent trustee model being a potential model for them. That's a longer sales cycle, so they're not going to happen every other month, so to speak. But we do see a smaller number of opportunities of significant size that could translate over the next 2-3 years as time goes on.
Thanks, Andrew. Other question, Dee? Yep.
Just two questions. Just the first one, just on the Perpetual appointment. Can you talk? You've talked about the revenue side. Can you talk to any incremental costs that come across with that book, or whether they're kind of what the operating leverage of the existing infrastructure is?
Yep.
And the second one is for you. Is just on the M&A side. You kind of talked to the low gearing of the balance sheet and the progress that you've made with the acquisition. So how are you thinking about M&A from that perspective?
Okay.
So on the Perpetual side, with the movement in our superannuation book, where Mick had talked about, and I've talked about, that we've had a little bit of consolidation occurring within the book. And so therefore we could bring Perpetual into our business with no additional incremental spend because of the consolidation that's occurred on one side, and then the coming on board of Perpetual on the other side.
And then on your second question, I guess while we were going through the AET integration, we really down tools on looking at M&A, but we started becoming a lot more active, 4 or 5 months ago, and we have been out talking to different parties and just reminding people we're interested in, trustee businesses, and there's quite a number, primarily in the corporate trust side, but there's a few also on the private client side, we won't be making any announcement, in the next week on anything, but we are being considerably more active at this point in time. And I think there is opportunities that are emerging. Whether we're successful, remains to be seen, but we're certainly participating. Yeah. And most of those, quite a number of those could be done within the current balance sheet capacity. There's a couple that would be outside of that, which would require capital. Yeah. Any other questions? They don't have to be, yep.
Maybe just on the technology side, I think you mentioned the first phase for CSTS is on data and analytics, but what do you see the opportunities for workflow and automation, given the significant investment you've made in TWS the last couple of years?
Yeah, CSTS fundamentally is quite different to TWS. I think Mick had one of those slides there where effectively in TWS we do a lot of demonstrations, a lot of processes, where CSTS, they tend to be more task-orientated workflows. So we have platforms such as Salesforce, we've got databases, etc. So that's the type of stuff that we're looking at, actually making it a little more efficient for CSTS at the moment. It's really about good workflow management, consistent approaches to various different things, utilizing our data a lot more. I think that's where we're trying to focus on with the business.
And maybe I can add there as well, that particularly on the data side, on the corporate side, is about helping us to manage risk. So when we oversight all of the service providers that we have, when we oversight the investment managers that we have, how do we proactively utilize data to help us to mitigate that risk? And then as Ping was talking, once we have all of that in place, that gives us the ability to do more predictive analytics as well, to actually forecast where our greatest risk might be across our portfolio. And that relates not just to structured data, but also unstructured data. So when we think about disclosure documents that we have in market at any one given point in time across all of our funds in corporate and in super, how do we leverage that data efficiently so that we can immediately understand where risk is and whether there's an issue in market, we can do that in the most effective way. And the first part of that is getting all of that organised so that we can then use that to help us to manage and mitigate the risk.
Yeah, I'll just add to Andrew and Ping's comments there. The reality is that the corporate trustee services business and the superannuation business have probably grown to a scale and a level of complexity that maybe we didn't really anticipate. I mean, we were ambitious that we'd be able to keep growing, and that's happened. But they now sit at very significant scale, and hence, that business needs its own platform, basically, to, as Ping and Andrew say, to manage the processes, but also to be very, on top of risk identification. Yeah. Any final questions? Yep.
Hi guys. You've obviously had some great momentum in the corporate space recently, but the earnings are somewhat lagged that strong momentum, given, I'm assuming, ramp up costs, establishment costs. I'm just hoping you could maybe speak to the ability to close that lag, given you've got such a strong pipeline ahead of you.
Yeah. So the need to implement all of these schemes and then not only just from an implementation, but from an ongoing servicing, has needed, for us to ramp up in terms of resourcing to make sure that we can service appropriately. I think we're at a scale point now where we can deliver that margin growth through the resources that we have brought on board. And then importantly, the investments that we're making in the data and the workflow, client servicing through Salesforce, all of that infrastructure is now in place and we're adding to it, particularly in the data and the workflow space. So I think that growth has been very, very quick. We've had to put the resource on in order to manage that growth, but we think we're well positioned for managing that future growth as well.
And without talking about a downer, we did indicate about, I think, 18 months ago to 12 months ago, a loss. One of our clients lost a very significant mandate, probably one of the largest mandates in the country, right? When I say they lost it, transitioned out of the trust into a mandate. So we lost it in that respect. We didn't lose the client, the fund manager client. The fund manager has since lost the client completely. But so that was the largest institutional client within a CTS fund that we had in the book, and we don't have anything like that. So, CTS has held its own despite that because the rest of the growth's coming through. But of course, the growth that was pure margin, right? Basically, so the growth comes with workload. Yeah, I hope that makes sense. Yeah. Any other questions? No? Okay. All right. Well, we really appreciate you coming out this morning. Hopefully that was insightful. I'm not sure we'll be planning to do this every year, but I just think at this juncture, given we got good feedback last year about this Investor Day, that we would do it again. We haven't brought the whole team along, but we've got the A team. But no, you've got to see the leaders who are running the key parts of the business, which is very important, and not just hearing from Joe and myself all the time. So really appreciate you coming along. And if there's any questions, please reach out. So have a nice day. Thank you.